Hello, hello, hello. What's going on, everybody? Welcome to a capital hungry higher time frame macro analysis webinar. So those of you who are veterans in capital hungry know that towards the end of every month or start of the month, we always like to do some higher time frame analysis to understand the overall bigger picture, keep a bird's eye view on the markets, keep ourselves mentally objective, and also be able to project some potential movements to come on a longer term perspective that we can keep in the back of our head as we play that bias. Okay, so from the last higher time frame webinar, we have had some significant changes fundamentally that can be shifting our higher time frame bias. That, of course, being the Russia tensions, the escalation of Russia invading Ukraine, potentially turning into World War III, and so forth. So for the example, I want to talk about gold first. For those of you who remember, we were looking at a high potential of historical repetition as long as we did not have any new market fear come into the scene. So let's take our time and break this down. Obviously, over the course of the last 2 years, we had the pandemic active. This kept gold extremely bullish on top of low interest rates, low inflation, and of course, that market fear. But as COVID was getting priced in, and we were also recovering from the pandemic coming out of lockdowns, and the feds were starting to switch into a more hawkish tone, we were having similar repetition of failing to break significant high price points and starting to show some more sellers pressure, driving down to these same demand zone lows, right? Then we had something completely shift that potential of historical repetition. Of course, being new events that came in, bringing new market fear, uncertainty, and doubt, right? So that being the Russia tensions. This so far completely scraps our plan of seeing the historical repetition, as the historical repetition was primarily based on the idea that if the pandemic is over and all of that fear is priced in, and we start to reach interest rate hike territory with no new market fear, then there's not really a reason for gold buyers to continue to keep pooling in from these high points. Most likely you'd see gold enter a bearish corrective phase. Does everybody remember that? And does that make sense? Right? So we were riding the gold buys for the last 2 years, but we were identifying over specifically the last 6 months as the feds turned more hawkish, as pandemic was starting to fade out of the markets, as countries were coming out of lockdown and COVID was starting to dissipate, that gold was starting to show a lot more sellers pressure, driving down into these same potential lows for that historical repetition to take place of some bearish corrective structure. But of course, the historical repetition can only take place if the same events take place as they did in history. Here, you had the 2008 financial crash and then the recovery, right? Meaning the economic crisis was the 2008 financial crash. It led to an explosion in gold for the following years. As you recover from the financial crash and don't have any more fear catalysts, you can see you have this correction in the markets. And then we didn't see those Ukraine and Russia tensions until 2015, 2016. Because remember, Russia tried to invade Ukraine before, and this has been something that's ongoing since that 2014, 2015 period. But that pause between around 2012 to 2015, where there weren't really any negative tensions in the market. Remember, Brexit came into the scene 2015, 2016. Russia started invading Ukraine 2015, 2016. There was a period of time between the financial crash from about 2012 during the recovery till about 2015 where there wasn't really any long-standing market fear. Does that make sense for everybody? So timeline-wise, 2008 financial crash, the financial crash pretty much extended until 2012, lasted 3 to 4 years, right? But then from 2012 to about 2015, from a global perspective, the fundamental fear was relatively low. You were seeing more market recovery, more economic recovery, interest rate hikes by central banks, and so forth. Then we saw more market fear come into the scene 2015 and 2016 from a global perspective, with Brexit from the GBP and Euro side, and from the Euro side, as well as Russia starting to invade Ukraine. Everybody understand that? Right? Yes, no? So this is why, obviously, during that couple of years where there wasn't as much market fear and interest rates were high, gold obviously enters that bearish market for that 2-year period, because interest rates are high. You just peaked an all-time high price point. There's no real fundamental reason to keep buying gold. The global financial crisis is done. There's no war or Brexit going on yet. And you see gold enter that bit of a bearish market. And then when do gold buyers start to pick up again? What year do gold buyers really start to pick up again? Around 2015, 2016 is where you see that pullback phase come to an end. Then 2015, 2016, you had the Russia tensions of potentially invading Ukraine. You had Brexit come into the scene. Couple years after that, Trump comes into the scene, the trade wars, Iran tensions, and pandemic. Right? Now, the difference between the previous timeline and this timeline is that there has been no pause between fundamental fear catalysts. Here, remember, you went from the 2008 financial crisis, the recovery at 2012, and then you had about that 2-year pause where there wasn't really any major substantial global tensions. But this time, it's not the case. And I wasn't expecting these Russia tensions either. I was personally expecting maybe some Middle Eastern tensions, or the US going back to revisit the Iran situation, maybe going into 2023. You know what I mean? So when Putin came to the scene so aggressively, even I was like, damn, pandemic straight to world war. Like, this is nuts. It's just constant volatility, right? So we had the pandemic take place 2020. Obviously, you guys understand Brexit, Russia starting to invade Ukraine, Trump coming into play, Trump's trade war era, Iran tensions, pandemic, and you get the idea. Gold during the Trump era, trade war, Brexit, war tensions, and so forth, and pandemic explodes in value, right? The pandemic gets priced in. The pandemic gets digested. The lockdowns dissipate. The pandemic fear dissipates. But we did not have any period of recovery or any period for the markets or essentially for gold to breathe or correct, because pretty much we transitioned instantly from COVID to this war, to this invasion of Ukraine. And there hasn't really been an actual official end date of COVID. We just saw this seamless transition into the war tensions by mainstream media and politicians. Anybody else notice that? It's not like there was some information that came out that COVID cases are gone, or that the vaccines are working, or that there's no more spread of the cases. That's not the case at all. We just saw this seamless transition where we were going into now what is the Ukraine war tensions. Okay, does that make sense to everybody? So what I'm trying to communicate very simply to everyone is that the complete attention shift from pandemic to Russia and Ukraine scraps our historical repetition plan, right? The historical repetition plan was looking good until new market fear came into the scene that prevented gold from breaking that demand zone and from having that corrective structure. Everybody following along? So now, what we can see on the quarterly and even on the monthly timeframes is much stronger bullish price action starting to clear above significant price sensitivity areas, with the potential in this bullish trend to start chugging away, revisiting the previous all-time highs. right? We can notice this on the quarterly time frame with a bit more evidence, as above the previous historical highs, we're essentially starting to have more of a break and retest here. We failed to break that very key higher time frame demand zone at the 1680s. We're also breaking above these candle body price points of interest with potential target points of the all-time highs around the 2000 handle, 2100, and so forth. So when we're looking at the quarterly time frame, monthly time frame, and weekly time frame, we can see a lot more buyers in control. Strong. Basically, what we had was an impulsive move from buyers from a positional perspective from these lows. Profit taking that occurred here. A fail to break this very significant higher time frame demand zone. More buy orders being collected here institutionally. A shift in the fundamental sentiment that brought new market fear and potential for us minus some pullbacks to go chug back into these all-time highs. Does that make sense for everybody in terms of higher time frame analysis on gold and understanding the shift in fundamentals that's invalidating our historical repetition? And to me, even me, like I wasn't expecting that at all, like that instantaneous, seamless transition. I thought like, okay, after the pandemic, maybe the markets will have a bit of a breather for 6 months to a year, especially as we're having interest rates going up. And especially as we're at these record high price points on the stock market, on oil and so forth as well. I was okay. Maybe we'll see a higher probability of having that bit of a corrective phase before maybe years down the line, getting new market fear coming into the scene, right? That was my long-term projections. But when Putin comes to play and says he wants to invade Ukraine, obviously that's going to shift the media, political, and investor focus. And now the global sentiment is being impacted as we watch these war tensions. COVID doesn't even matter anymore, which is just mind-boggling to really digest and understand. The amount of attention, the amount of pressure, the amount of rules, regulations, and oppression of people through COVID was so intense. For them to just completely brush it under the rug now is just mind-boggling. You know what I mean? But anyways, does that higher time frame analysis make sense for gold? We're still, of course, on the intraday time frames, we've been in a bullish bias. We've been playing the fear tensions. We understand the impact on gold. But I just want everybody who is still remembering the higher time frame analysis to understand that the likelihood of that historical repetition is looking very low now due to the changing of real current event fundamentals. Right? That seamless transition from COVID fear to war fear is going to keep the sentiment the same in terms of fear, uncertainty, and doubt. All right. And you can see, obviously, the weekly time frame is further validating that with this huge weekly bullish candle close above this significant price sensitivity area with no lower wick, very strong bullish price action. Obviously, we're getting some sensitivity areas to the left here where we can get some reaction and pullback, but that would be ideal. If we can reject these areas, then on the intraday timeframes, get some pullback from here, just going to set us up some better risk versus reward buys as we're looking to target the higher time frame macro highs. Of course, now, yes, we do have Federal Reserve interest rate hikes coming, but how long have we been hearing about this March 25 basis point hike now? How long have we been hearing about the tapering process, the interest rate hikes to come, that they're gonna raise rates in March, that they need to start combating inflation? How long has the Fed been saying the same information? Months, half a year now, since mid-2021, correct? And especially over the last FOMCs, they keep reiterating about the March rate hike. What does that mean investors have already done about the March rate hike of 25 basis points? Bennett, 100% correct. Angelo, correct. It's been priced in because Ricardo, everybody correct. Because we know that the market, the greedy, smart money investors, they always want their edge. They always want to be ahead of the curve. They want to be 2 steps ahead of what's going on for the masses. So the market moves on anticipation. That's where that Wall Street that's where that Wall Street saying comes from about buy the rumor, but sell the actual news. The rumor of news always has more of a financial market impact based on the pricing in concept, the movements of order flow on anticipation of what's to come. So the whole idea of the 25 basis point rate hike, when they actually do that, if they don't do anything greater than a 25 basis point rate hike, in my opinion, stock markets are still going to push up. Gold is still going to be a stock market's going to have an upside quick push as investors are going to grab a dip, but gold is still going to be bullish on that macro market fear, right? I do still see the inevitable interest rate hikes and the war tensions being more bearish on the equity markets. That makes more sense, right? Because you have a macro fear sentiment, extremely high prices, and higher interest rates, which is all negatives for the stock market. But for gold, the only potential negative on gold in the current situation is aggressive rate hikes. But the 25 basis point rate hike has already been priced in, has already known. The tapering priced in, the rate hikes to come priced in. Unless the Feds do an aggressive surprise hike of 50 basis points, even in my opinion, that would probably have gold come smash down to like 1920, but still be bullish on the higher time frames due to the global fear sentiment holding more weight than just the individual US interest rates, right? Especially if we see NATO regions get further involved with the war tensions from an actual physical military standpoint. We've seen the economic sanctions. We've seen those sanctions escalate. We've seen Russia increase their interest rates to combat this economic war that the other countries are putting on them. But to see really further development of this over the next weeks and months, it will need to have the Euro regions a part of NATO and the North American regions a part of NATO actually start to give some military support, not just military equipment, not just selling weapons, but them making that conscious choice, the leaders of these countries to say, all right, this is escalating to a point, we're sending you our troops. And then you know what that means. Then Russia's allies get involved. Then you have more of a global conflict rather than just an invasion. Yes, the economic sanctions have a global impact. Yes, these various impacts on SWIFT or these sanctions on import and export or like these credit cards stopping the payments, of course, it's going to have an impact to a certain degree. But again, investors have been pricing in those events as they come. To see a huge explosion in global fear, you're going to have to see the other troops get involved. You know what I mean? But we're still looking to play that gold bullish bias. Gold higher time frame, the historical analysis is being invalidated, is incorrect, is very low probability of occurring because of the real world events that came into play of the transition from the COVID fear all the way into this war fear. Does that make sense for gold analysis? The structure, the trend, the reason why we failed to break this zone, and why we're having buyers come back into the scene. And have you guys been noticing that even when the Feds keep having their speeches, Jerome Powell comes, or like you have Bullard come into the scene and they talk about rate hikes, that it doesn't really even impact gold anymore? It's because that global fear holds a lot more weight, you know? Okay. Potentially even going into new highs. All right, before we go into GJ, we're going to quickly run through our US dollar pairs. Why am I going to quickly run through the US dollar pairs in the higher time frame analysis? Because our dollar bias is the same, correct? Regardless of these war tensions, we were still expecting dollar bulls because of what to come. And what have investors been pricing in on the dollar, keeping it bullish? First, of course, the tapering of the stimulus support. Then, of course, the interest rate hikes. Correct. Right? So before the war tensions, we were already higher time frame, intraday, fundamentally in a US dollar bullish bias as the Federal Reserve, the central bank for the US economy, was starting to shift their policy positioning, where that shift in policy positioning is fundamental bullish factors for the dollar, starting to regulate the supply, starting to taper the stimulus support, starting to look and talk about interest rate hikes. Now, because the dollar is also treated on a global scale as a safe haven currency due to the weight it holds as the world reserve business currency, during these war tensions, this is a further positive for the US dollar. So when the Feds have been talking about rate hikes on top of having the war tensions, this just has kept the US dollar on its more bullish path. And our higher time frame analysis of GU being bearish and just being in a higher time frame consolidation zone with the potential to revisit the zone lows, maintaining the overall bearish market structure, same exact higher time frame analysis, same macro bias. Sellers consecutively printing lower lows, only having pullback and corrective phases that don't break the structure. The impulsive moves on the higher time frame to either revisit previous lows or print new lows are much more aggressive, much more impulsive with the trend, larger confirms of sellers in control versus some of these corrective waves, which are larger bearish consolidation zones or pullbacks to retest certain supply areas to generate more sell orders before continuing down, right? What we can also see is a very strong price sensitivity area at these previous lows where we've had sell orders collected before with the potential of some very similar technical repetition, making our way down to 1.25. War tensions, bullish for dollar. Also weaker for the basket of risk currencies. Interest rate hikes, bullish for the dollar. Yes, interest rate hikes for GBP would be bullish for GBP, but would not overpower the dollar in this pair. Why? Yes, when the Bank of England raises rates against the dollar, it'll probably create some pullback structure on the intradays, but it's not going to fade out the overall bears because of why? Because in the majority of currency pairs that the dollar is housed in, the dollar holds more weight on a global scale due to being the world reserve currency and, of course, its safe haven appeal as the world reserve currency. Okay? That's why, like, if you have fundamentals impacting the dollar, it usually doesn't matter what's going on in the other currency. That dollar domination takes over, whether it's bullish or bearish. Now, you're going to see similar repetition on our expectations on the higher time frame of EURUSD, except EURUSD is much closer into nearing these lows of 1.05 with, in my opinion, high probability that once it finally breaks that low sensitivity area, we will melt down even lower. But once that seller's pressure is still very evident, US dollar strength stays in control. The expectations is, yes, we can come to at least revisit the bottom of the range, but with the weakness in risk currencies, strength in dollar, war tension still active, this looks very prominent. Very similar structure, very similar setup to GBPUSD as we're moving inverse of the dollar on the higher time frame. Now, we can further validate this concept of how these currency pairs will most likely follow dollar movement because of the fundamentals stated where USD CAD, what are you guessing the structure of USD CAD is going to be compared to GU or Euro USD with the dollar as the primary in the quote? Look at this Euro USD chart right now. Right? Correct bullish, but not just bullish. What are you expecting in terms of the structure compared to Euro USD? I'm personally expecting it to almost look like the inverse of Euro USD, or following similar to exactly the dollar index structure, right? So now when you look at UCAD, what do you see? Euro USD pushed up, started to create some bearish market structure, sellers consecutively printing lower lows, correct? Because of the dollar dominance, you have the opposite here. And now a consolidation zone above these previous price sensitivity areas, where if USD CAD doesn't break this price sensitivity area, it has a lot of potential on dollar strength to start chugging away back to these highs. Yes, USD CAD can get a lot messier during these war tensions because the majority of war tensions would have oil price very bullish and the Canadian dollar more bullish. But what did I just tell you holds a lot more weight in currency pairs? Right? So I'm expecting USD CAD to make its way up to the upside, but in this type of fashion, where on the intraday time frames, you're going to see very aggressive pullbacks, very aggressive waves as it's overall making its way to the upside because of those periods of indecision when oil is very high and the US dollar is high. But from a macro perspective, the US dollar strength should hold more weight in this currency pair, being the world reserve currency. But my expectations of the movement on this upside to come is very similar to here, where this, you have to remember here, right? I'm not expecting UCAD exactly, Taha. I'm not expecting consolidation, but when UCAD's doing these very aggressive waves, as its overall price is edging up, that's exactly what I'm expecting. I'm expecting UCAD to go up in price, but with very aggressive waves. This was that same 2015, 2016 period of war and invasions, and you can see the impact it had. So yes, as long as we don't break these lows, I still expect dollar strength to dominate. But as we're making our way to the upside, I don't expect some very clean structure. I expect a movement like this. Does that make sense to everybody? Based on how it's moved previously, technically, based on that tug of war that can be created with the oil strength and dollar strength, but price is still going to be overall going up because of the dollar domination in the currency pairs as the world reserve currency. Right? Now, that makes perfect sense where we expect dollar bulls with war tensions escalating, interest rates going up. We can see clearly bearish structure, bearish price action on Euro USD, clearly sellers in control, bearish price action, bearish structure on GBP USD, and USD CAD being the inverse. Very easy to understand and confirm those concepts. Now, GJ is something we have to keep an eye out for now, because yes, we have been playing the historical repetition of the bounce from these lows. But what's very interesting is every time we conveniently hit this bearish trend line here, a fundamental catalyst seems to come into play that's bringing mass market fear. Isn't that very interesting, right? Here, everybody understands this giant meltdown was GFC, Global Financial Crisis 2008, right? Here, everybody understands this meltdown on GBP against the yen was more market fear coming into play, with mainly being Brexit but you also have yen strength with the Russia-Ukraine tensions at that time too, the previous invasion, 2015, 2016, 2017, right? So we've had great rallies off this demand zone. We played these buys here perfectly, but what we can start to identify now is at this very significant institutional price point of interest and trend, we're now conveniently having more market fear come into play with the Russia and Ukraine tensions coming back down. Isn't that really interesting? Doesn't that make people like think twice too now? Like, wow, these market moves are not random. The price positioning, the reactions, the timing, it's very planned. It's very like convenient, strategic, almost surgical, right? Even when the pandemic crash happened, which was this candle, it was very convenient, very strategic, very surgical how it came down to that same institutional buyer demand zone and had a huge upside rally since, right? 120 all the way to 150 there. And now, the same time we're coming to retest what we identify as technical bearish market structure, we have Russia invading Ukraine, right? So we have to be very cautious of our higher time frame GJ bullish bias as long as these Russia and Ukraine tensions are going on. Because yes, the Bank of England can look to raise interest rates, which would be a positive for the British pound. But if these war tensions continue to escalate, then that global financial impact of the war tensions would outweigh the individual rate hikes of GBP in the pair GJ, right? Because the Japanese yen is a safe haven currency. It would explode if war tensions escalate. Those global war tensions, that global liquidity movement in the safe haven would overpower the individual rate hikes of GBP. Everybody understand that? Measuring the economic impact based on the severity of the catalyst, right? It's like when you look at the British pound 2013, 2014, there was actually interest rate hikes going on, but something like Brexit and the war tensions would completely take over that. Okay, so on GJ, we can see a lot more exhaustion, especially on the monthly time frame, starting to create a order block at this high sensitivity area, which is the retest of that bearish market structure we're looking at those high points. You can also see a order block and a lot of price sensitivity across the board here, with a lot of areas that we need to break above to signal a lot more buyers pressure in the market. My expectations with the current yen strength, with the current weakness in the UK equity markets and investor confidence starting to drop, is that there's a lot of potential we can start to drive back down to these demand zone lows. And if we drive back down to these demand zone lows and break, we can start to see some more bearish price action, bearish market structure on the higher time frames and intraday time frames, but that is going to be evident on the severity of the war tensions. Okay, but some things we can't ignore and we can't just brush aside is that bearish market structure is still being respected. We're having a higher time frame order block being created. A lot of buyers rejection at that 158 price point and sellers jumping in. The same time across the board here, it is a very key price sensitivity area. Here on the monthly is where we broke below that order block. You can see here's where we had a pullback in previous revisitations of the low here. You can see here we had rejections and failure to break. Same thing right here. That higher time frame range of about 158 to 159 is a very, very strong seller zone that we can identify based on our technical observation, right? Does that make sense? Just based on technical observation. But what's interesting is that technical observation and technical moves is being induced at these very specific price points by those real world fundamentals. Crazy, right? So in the near term, I am more in a bullish bias on gold. I am more in a bullish bias on the US dollar and Japanese yen individually. Because let's look at something here. Obviously, we don't have to look at the dollar. You guys understand dollar bullish, why it's bullish, the expectations of dollar being more in a bullish order block here, potential to revisit these high points. We all understand that, the fundamental reasons. But something else we have to keep an eye on the Japanese yen index here, when we're looking at it on the 3-month and the 1-month time frame, is that this price sensitivity area here across the board is a very, very, very strong zone historically, right? And at this area around 85 to about 88 here on the Japanese, yes, we had great downside moves down to this low area, but you can still see this higher time frame order block in this general price sensitivity area. What we can see on the Japanese yen is that we're starting to get a lot more exhaustion on the higher time frames at that price sensitivity area. If we see the yen start to hold above that 88 price point on the intraday timeframes and more market fear and fail to break these lows, we can easily see sellers take profit, buyers jump in from a more favorable low price point on the yen. The same time, the buys are more favorable because 1, like I just said, lower price, and 2, fundamental reasoning for yen to pick up some strength in the short term. Does that make sense? We can also see that evident here. It was easier to look at the line charts in the higher time frame. We can also see that evident here when you're looking at these price sensitivity areas I'm talking about. So tons of exhaustion at these lows. This is also that higher time frame zone to the left. The same time, more market fears coming to the scene. You can even see this double bottom forming on the daily. If we hold above this double bottom leg, a lot of potential to edge into 87.5 and 88 there, if the market fear holds more weight. So the same time, look at this. The same time Japanese yen is coming to significant historical lows and showing exhaustion, failing to break double bottom, right? Remember this. What is GBPJPY showing at its highs? Almost the inverse, correct? Isn't that very interesting? Doesn't that validate those technical and fundamental concepts, validate the correlations? So if yen starts to continue to edge up to those intraday high points, what we can expect from GJ is potentially coming back down to 150s, back down to 149s. Also, GJ is looking like much similar repetition to what we saw happen here to the left now as well. Does that make sense for everybody? So now, to give you some more information as guide points, I honestly can't see any more higher time frame buys on gold, on GJ myself, really until we were to clear these highs. We've had great buy plays up to here, but what do I teach you about buyer and seller order flow and transactions? What are we clearly seeing here about buyer volume? Dying out, exhausting, not enough volume to break higher, right? We can see here that we had this revisitation of the highs, a pullback and failure to break those highs. Now, this downside move is much larger than this downside move. The probability of coming to these lows, and if market fear extends, even breaking these lows, is starting to look more prominent. We're seeing much more aggressive profit taking by buyers at the highs. And not just that, sellers also starting to take control as well over the GJ market here because of those fundamentals stated. Does that make sense for everybody? So it's looking like when we're looking at gold, we're looking at GU, we're looking at GJ from the higher time frames, macro fear is more prominent. Why is macro fear more prominent? Because we had this seamless transition with very little breathing room from COVID to these war tensions. And these war tensions are active and hot right now. Literally, you guys all, what has the newsroom been filled with? Have you guys seen any more COVID reporting cases in the newsroom even too? Now that I think about it? Or vaccine headlines? It's all Ukraine. It's all Ukraine. It's all NATO. It's all war. You know what I mean? It really doesn't even exist anymore. Like, honestly, it's crazy. It's mind-blowing. Something that was dominating our life for 2 years impacted our mentality, our money, our lives, our families. Just as a snap of a finger, boom, poof. Yeah, and I saw that document released too. Wasn't it like 50 pages of like side effects or something? That's just conveniently brushed under the rug now, hidden away during the war tensions. It's crazy stuff, right? So we're seeing more macro fear relevant. We're seeing the price action and the market structure confirm this. We're also seeing the correlations confirm this and the market sentiment confirm this. All right. We can also see this in our one more confirmation in the equity markets. We haven't seen a candle like this since before the pandemic. In the pandemic, this is actually, I know it's mind blowing. The stock market buyers are finally starting to take some profit out of this 2-year rally. We're starting to finally enter that corrective bearish market phase. Now, what are the fundamental reasons why we're seeing, what are the fundamental reasons why we're not seeing as much buyer order flow flood into the stock markets, even though we know smart money is so greedy due to human psychology? What are the various reasons? First, number one, right? Rate hikes, inevitable rate hikes to come. At number one, first is what price are we at, right? Don't forget, we just had a huge rally from around 18,000 to literally just shy of 38,000, almost a 20,000 point rally. That's absolutely insane. Look how long it took from US 30 to go from 6,000 to 16,000 and do a 10,000 point rally. It took from 2009 all the way till almost 2017. But just in 2 years, we went from 18,000 almost to 38,000. I'm just going to roughly say 20K points. You guys get what I'm saying? You know what I mean? Roughly, we're going to say a 20,000 point rally there, right? So now, what were the reasons that made buying into the stock market so favorable for the rich here? Well, you had discount prices and very low prices across industries in the stock market, correct? That's rule number one. You want to buy low, sell high, basic investing, right? At the same time, you have low prices. You also have low interest rates, which makes it more favorable to purchase more stocks and hold them longer as you're paying less interest, right? So low prices is number one, check mark. Number two is low interest rates on top of low prices. Number three, the Fed's money printer that goes to flood the stock market in the support of the central bank. Number four, that money printer leads to inflation, which inflation itself will inflate the value of the stock market. Number five, the market fear, uncertainty, and doubt of the pandemic, right? Low prices, low rates, money pumping, inflation, fear. The fear of the pandemic being digested, not the fear of the pandemic causing the upside move. The fear being digested and then coming out of lockdowns for the US. Yeah, Dennis, thank you. Low prices, initial COVID fear causing low prices, discount prices, central bank low interest rates, money supply pumping the markets through the APP, that leading to inflation, all bullish factors for the stock market, on top of the smart money investors pooling in and riding that wave. Now, when you look at those same selections of reasoning that kept the market bullish, we're starting to have the inverse. High prices, high interest rates coming up, asset purchase program dissipating and tapering taking place, inflation starting to be combated by increasing interest rates, stopping of the asset purchase program, and new fear with Russia tensions. The same reasons that made the stock market so favorable to invest in back here is now having the inverse and opposite taking place here. Now, we understand that there's not going to be another market crash essentially because the stock market buyers don't want to kill their entirety of their gains, but a correction to take place to set up a better dip before continuing up is perfectly viable. Does that make sense to everybody? What would show me a lot more price action confirms of buyers taking profit and sellers jumping in is if this quarterly candle in the next month, when obviously we have this 3-month period come to an end, if it can close below these candle bodies, more specifically engulf this previous bullish push, that shows me a lot more potential that if tensions are still hot, that we're going to have that corrective structure on the intraday timeframes and more of a bearish market take place. Not a market crash, but potentially something like this, all the way down, maybe into those pre-pandemic price points. Maybe come down to 28, 30K before seeing another continued rally again. Does that make sense for everybody? Right? So even on the intraday timeframes, we can see starting to hold a lot more pressure below that demand zone, new lows printed by sellers, bearish higher time frame market structure starting to form, and a lot more profit taken by buyers at these 37K highs. So across the board, we can see that market fear from a macro perspective is a lot more prominent. Of course, on the intraday timeframes, there's going to be certain days or weeks where we're going to be playing some pullback structure because we're not just going to have a continued dump. That's not the way the market moves. The market moves in waves. But what we have to understand during this higher time frame webinar is that as long as these tensions continue to stay active or escalate, macro market fear will be more prominent, meaning more higher time frame macro dollar strength, yen strength, VIX strength, weakness in equities, strength in gold, strength in oil, and so forth. All right, everybody. So hopefully that was informational. That was educational. It gave you a good review of the higher time frame, zooming out, always keeping our minds fresh, right? We do this every month for that reason, to stay objective, to see what's going on in the bigger picture of things, because at the end of the day, we're human beings. It's very easy to get distracted, very easy to get lost. A lot of us are scalpers or intraday traders. It's very easy to get zoomed in on just the time frames we focus on. And sometimes that can lead to you becoming more subjective rather than objective. You ignoring a lot of other factors, getting so hypnotized into the smaller time frames or what's going on every single day and not keeping an eye out of the macro image, right? For example, understanding the macro image is what helped us keep just stacking US 30 buys over the course of the last 2 years, regardless of these fear pullbacks. Understanding the macro image is what kept us playing GJ buys even when we revisit this demand zone multiple times, even with some of the aggressive pullback, short-term fear, and so forth. Understanding the macro image is what helped us stay adaptive to gold, not get shaken out when you have some heavy intraday pullbacks or so forth, right? But we're starting to see that macro optimism starting to shift back into macro fear for the reasons given. So I'm going to save and upload this. I'll send the rest of the weekly flow soon. I already recorded a weekly recap webinar. If you want to watch it, it's saved on Vimeo. I just didn't send it to the chat yet. All right.